Let me ask you something uncomfortable. Do you really own your home? Or does the mortgage system actually own you? This is not about bad decisions. This is about a debt racket hiding in plain sight. If you're middle class, chances are you're already inside the mortgage trap. This is the housing debt crisis nobody explains clearly. In this video, I'll break down the financial system, explain the way banks never do. Finally understand amortization explained and how compound interest debt really works. The homeownership myth keeps millions financially stuck. How banks profit from debt and why debt keeps you poor. It's importantly, how to escape the debt cycle and reclaim financial sovereignty. You see this, you'll never look at debt the same way again.
What is the difference between a loan shark who threatens to break your legs and a bank that hands you a mortgage? Here's the uncomfortable truth. The loan shark is actually honest about how much he's going to take from you. And by the end of this video, you're going to understand exactly where your money disappears, why your balance barely moves, and how this system was engineered so that it never really lets you go. It sounds like a joke, doesn't it? But pull back the curtain on the financial history of the last century, and you realize the punchline is on us. We were trained to see banks as pillars of the community, friendly institutions helping us reach the ultimate symbol of adulthood, homeownership. But what if that handshake across the mahogany desk isn't a partnership at all? What if it's the most sophisticated, fully legalized protection racket ever created? Welcome to the darker side of the American economy. We grow up hearing about the American dream. We're told that buying a home is the smartest financial decision we'll ever make, the foundation of middle-class wealth. But pause for a second and ask the question no one wants you to ask. Who actually gets rich in this deal? Because it certainly isn't the family spending the first 15 years of a 30-year mortgage paying almost nothing but interest. This isn't corruption hidden in alleyways. It's a masterclass in political economy, signed neatly in air-conditioned offices. Think about how organized crime really works. The mob runs a racket by creating a problem and then selling you protection from that very problem. Now look at the modern mortgage system. Cheap credit inflates housing prices until paying cash becomes impossible. That's the danger. Then the system steps in with the solution: a lifetime of debt. This is Wall Street's business model, clean, legal, and sanitized by lobbyists and marketing departments. They don't want you debt-free. To a bank, a customer with zero debt is worthless. They want you permanently on the hook, and you felt this, even if you couldn't explain it. You make that huge payment on the first of the month. You check your balance, and it feels like nothing changed. That sinking feeling in your stomach isn't paranoia, it's design. Because at that moment you realize something disturbing. You don't own the asset. You are the asset. Your house is the bait. You are the yield. You are being farmed for interest. But stay with me. This isn't just a rant. We're going to dismantle this system piece by piece. Once you see how this trap was engineered, the illusion breaks. What they rely on most is acceptance, the belief that this is just how the world works. But when you understand that the mortgage industry operates with the same extractive logic as a gambling bookie, just with better branding, your entire view of money starts to shift. What you're about to see may shock you, or it may simply confirm that quiet suspicion you've carried for years, that the game is rigged. The bank pretends it's doing you a favor, but in reality, you're the one signing away decades of future labor to stabilize their balance sheet. They collect the interest, you carry the risk. If the market crashes, you lose your home. If it booms, they still win. Heads they win, tails you lose. But to truly expose this racket, we have to step past the anger and look at something far more dangerous: the math. The cold mechanical numbers hidden inside every mortgage contract. Because once you understand the math of extortion baked into the amortization schedule, you can never unsee it. And that's exactly where this story really begins. It's strange, almost tragic, how we spend years in school memorizing formulas we'll never use, yet no one ever teaches us how debt actually works. The moment we get our first real paycheck, we're handed contracts filled with numbers we don't fully understand and told to sign. That silence isn't accidental, because when you understand only the monthly payment and not the total cost, you're easier to manage. Complexity becomes a tool, not a coincidence. Financial language isn't boring by mistake. It's engineered to exhaust you into compliance. And that's why this conversation matters. Not in an abstract academic way, but in a deeply personal one. Because almost everyone watching this has felt it at some point. That uneasy feeling that something doesn't add up, even though the numbers are right there on the page. That quiet suspicion that the game might be tilted, but you can't quite explain how. If this is already resonating with you, do one simple thing right now. Hit the like button. Just that. It's a small click, but it tells the algorithm that conversations like this deserve to reach beyond the usual bubble. No speeches, no commitment, just a signal. Now let me ask you something. Keep it simple. Have you ever looked at a loan statement and thought, how am I still owing this much? If yes, write just one word in the comments. Trapped. Nothing more. One word. You'll be surprised how many people feel the exact same way. Because that moment, that sinking realization when you see how little of your payment touches the principal, isn't a personal failure. It's not a lack of discipline or intelligence. It's a design feature. And when people start sharing that realization, something powerful happens. Isolation turns into clarity. If you want to keep unpacking these systems, slowly, calmly, without hype, make sure you're subscribed. Not because of me, but because this channel is becoming a space where people stop blaming themselves and start understanding the structure around them. That understanding is the first step toward financial sovereignty, and it only grows when more people participate. Now here's where things get concrete, because outrage alone changes nothing. To really see how this system tightens around people, we have to examine its favorite tool. On the surface, it looks like harmless math. Predictable. Logical. But once you understand how it works, you'll realize it behaves less like arithmetic and more like a restraint. Let's break down the numbers. You're entering territory most financial advisors avoid, not because it's complicated, but because it threatens the foundation of how the system profits. So take a breath. We're not here to panic. We're here to see clearly, to understand why modern debt feels less like a tool and more like a trap. We have to strip away the emotional packaging. Forget the commercials. Forget the word dream. Look only at the mechanics. In organized crime, there's a term called the VIG, short for vigorish. It's the interest a loan shark charges, not to get the money back, but to keep the payments flowing. The mob doesn't want the principal. They want the stream, the weekly envelope, the juice. Now pause for a second. Look at your mortgage statement. They call it interest. They soften it with tax deductions. They dress it up as normal. But structurally, functionally, it serves the same purpose. It's the VIG. It's the price of admission to ownership. And the price is designed so the house always wins. Now here's where it gets uncomfortable, but also empowering. The word amortization comes from the Latin admortire, meaning to kill. In theory, it's the process of killing a debt. But notice how this system chooses to do it. Slowly, painfully, with maximum extraction up front. When you sign a 30-year mortgage, you're not just agreeing to a loan. You're locking yourself into a mathematical sequence that heavily favors the lender in the early years, precisely when most people are the most vulnerable. If you've ever actually studied an amortization schedule, not glanced at it but studied it, you know the feeling. Pride, then confusion, then frustration, and finally, clarity. Picture this. You buy your home. You feel accomplished, responsible, secure. Your monthly payment is $2,000. You pay it, thinking you just reduced your debt by $2,000. But look closer. In the early years, roughly $1,700 of that payment disappears into interest. Gone. Bonuses, dividends, polished marble lobbies. Only about $300 touches the principal. That means 90% of your payment is profit for the bank, and 10% is progress for you. Pause here. Let that land. This leads to a realization most people never articulate. You're not buying a house, you're renting money. And the rent is highest at the beginning, when you're stretched thin, building a family, establishing your career. Technically, you're a tenant with full responsibility. If something breaks, you pay. If the roof leaks, you pay. But when the check clears, the bank keeps the lion's share. Perfect business model. All upside. No maintenance. No risk. And now, this is where the trap actually snaps. The system depends on one predictable human behavior: movement. Most people move or refinance every 5 to 7 years. New job, kids, divorce, downsizing, upsizing. The architects know this, because if you sell after 7 years, you've spent almost that entire time paying interest, not principal. You walk away with minimal equity, roll it into a new home, sign a fresh 30-year mortgage, and reset the clock. Back to year one, back to peak interest, back on the treadmill. You work harder, you earn more, but you don't move forward. Now here's the important shift, the light most people never see. This isn't because you're bad with money. It's because the system is optimized for compliance, not freedom. Heavy debt makes you cautious. It makes you obedient. It makes risk feel dangerous, even when risk is how people grow. You don't quit the job. You don't start the business. You don't speak up. Not because you don't want to, but because you can't afford to. This is modern indenture. Clean, digital, polite. The chains aren't visible, but the pressure is constant. And yes, this realization hurts. But pain here is not punishment. It's orientation. Because once you see this, you stop making decisions based on myths. You start asking better questions. You recognize that refinancing for lower payments often just extends the sentence. More interest, longer dependency, delayed freedom. Comfort today, cost tomorrow. If this is clicking for you, if the structure is becoming visible, say it out loud with me. Go to the comments and write, "I see the trap," not as anger, as awareness. Because awareness is the first step out. Now we need to go one layer deeper, because understanding your monthly payment is only the surface. The real story begins the moment the ink dries on your signature. Most people still carry a comforting, almost nostalgic image of banking. We imagine that the local bank lends us money from its own vault, keeps our mortgage for 30 years, and waits patiently for our monthly payment. That story implies a relationship. It implies that if things get hard, you can walk into a branch, sit across from a human being, and work something out. That world no longer exists, and it hasn't for a long time. Here's the truth most borrowers never see. Your bank never wanted your mortgage. To them, your loan is a hot potato, something to get off their balance sheet as fast as possible. Holding debt is slow, it's risky, and Wall Street doesn't like patience. So what happens instead? Within days, sometimes weeks of you getting your keys, your mortgage is bundled together with thousands of others: teachers, nurses, mechanics, young families, retirees, thrown into a giant financial blender. This process is called securitization, but think of it like this. Imagine you bake a single loaf of bread. The bank slices it into thousands of crumbs, mixes it with other loaves, repackages it, and sells the bag to someone across the world, who has no idea where the bread came from and doesn't care. That bag is called a mortgage-backed security. And now, your debt is no longer local, it's global. Let me make this personal for a moment. Picture a guy named Mark. Mark buys his first home. He's proud, nervous, excited. He sets up autopay and sends his first mortgage payment, believing it goes back to the same bank that smiled at him during closing. But in reality, that money flows through a servicer, a middleman, then onward to a pension fund in another country, a hedge fund in New York, or an algorithm trading bonds at lightning speed. No one in that chain knows Mark. No one knows his kids. No one knows if he gets sick, laid off, or struggles. Mark isn't a person anymore. He's a cash flow. This is the moment where borrowers quietly lose their humanity. In the old system, a banker evaluated your character. In this system, you are a line item, a yield percentage, a variable inside someone else's model. This shift, from relationship banking to securitized debt, explains why the system feels so cold, so mechanical, so unforgiving. Because once you become a product, mercy disappears. We're taught to be proud of our credit scores, to treat borrowing as adulthood. But behind the scenes, that score is just a quality rating, a label that determines how your debt is sold. Prime, subprime, different labels, same outcome. You are the product. And we've already seen where this leads. In 2008, the entire world watched this machine collapse under its own greed. Toxic loans packaged as gold, homes turned into chips at a casino table. Here's the part most people missed. The system didn't stop. It evolved. The rules got longer. The language got denser. The algorithms got faster. Today, your mortgage can be traded thousands of times without a single human decision. Your home, your shelter, is now a high-speed financial instrument. And this creates a brutal incentive loop. Investors want higher returns. Higher returns require higher interest. Higher interest inflates home prices. Inflated prices force buyers into larger loans. More debt means more product. More product means more profit. You work longer hours. You stress. You sacrifice. They clip coupons. This is extraction at scale. And once you see it, something changes. That pressure to buy now or be priced out forever? That's not urgency. It's marketing for the bond market. The question becomes unavoidable. Is housing designed to shelter families or to feed Wall Street's appetite for yield? When you peel back the layers, the answer is painfully clear. And here's the most dangerous part. Because the owners of your debt are anonymous, there is no negotiation, no conversation, no understanding. When you pay, you're an asset. When you stumble, the system flips instantly. Automated, algorithmic, merciless. No ears, only protocols. If this realization, that your mortgage is traded like a baseball card, changes how you see the system, I want to hear it. Go to the comments and write, "I am not a product," because seeing behind the curtain is how this story starts to break. And next, we need to talk about what happens when the music stops, when the fine print finally comes due. Realizing you've become a product is disturbing, but that's only half the story. Now we have to face the lethal consequences of that status. This is where the system stops being unfair and becomes dangerous. Welcome to what I call the collateral trap. This is the exact point where everything shifts, where math turns into a threat, where a contract stops being paper and starts deciding the fate of your family. When you sign a mortgage, you're not just taking on debt. You're making a quiet confession. I don't have enough capital to play this game on my own. And by admitting that, you agree to play by their rules. Rules written with surgical coldness, hidden behind layers of polite legal language. Let's get to the core. The bank requires your home itself as collateral. On the surface, that sounds reasonable. But now run the scenario that keeps millions of people awake at night. What happens if the economy turns? If your company downsizes? If a merger, a crisis, or an AI system makes your role redundant? What if you get sick? At that moment, empathy disappears. You could have paid your mortgage perfectly for 10, 15 years. You could have sent the bank hundreds of thousands of dollars in interest. None of that matters. The system doesn't look at your history. It looks at the default clause. Foreclosure begins without anger, without emotion. Foreclosure is the purest expression of the power imbalance. Automated, algorithmic, ruthless. And here's the part almost no one says out loud. In many cases, the system makes more money by taking your house than by letting you keep it. Through insurance, derivatives, and cross-collateral structures, the bank can keep all the interest you already paid, take the property, and resell it to the next hopeful buyer. You lose everything. Credit destroyed. Years of sacrifice erased. No second chance. Now pause for a second, because this is where the real truth hits. This isn't accidental. It's risk asymmetry. When massive banks make catastrophic mistakes, what happens? They get bailed out. With public money. With your money. Executives keep bonuses. Stock prices recover. The system protects itself. They are too big to fail. And you're too small to matter. When you fail, there is no bailout, no instant safety net, no forgiveness. You carry 100% of the risk. They keep nearly 100% of the reward. That's not a free market, that's a racket. And here's the critical pivot. Pay attention. This isn't about hate. It's not about blind rage. It's about strategy. Because once you understand this structure, you stop blaming yourself and start seeing the full design. The system creates the problem, floods the market with cheap credit, prices explode, saving becomes impossible. Then it sells the solution: long, expensive, unavoidable debt. And when the system itself breaks, it collects the assets. Inflation created by them, interest paid by you, collateral seized back. This reality reshapes behavior. You stay in jobs you hate. You avoid risks that could free you. You tolerate abuse. Not because you're weak, but because the cost of failure is total ruin. That constant fear isn't a side effect. It's the mechanism. And this is where the narrative must change. Foreclosures are not personal failures. They are predictable outcomes of a system engineered to transfer wealth. When a neighbor loses their home, the story says irresponsibility. But zoom out, and you see financial engineering working exactly as designed. Now here's the mini cliffhanger that changes everything. Even if you survive, even if you pay every installment, even if you reach the end of 30 years, what if the prize at the finish line is another illusion? What if the house, sold as the greatest asset of your life, was never the investment they promised? That's the next layer, and it's even more uncomfortable. But before we go there, I want to take the temperature of the room. If this logic of bailouts for them, evictions for you, feels deeply unjust, go to the comments and write just one sentence. The game is rigged. Not as rage, as clarity. Because now that you see the board, it's time to question the most sacred piece of all, the myth of the asset. And this brings us to the most uncomfortable realization of all, the one that challenges the holy grail of conventional financial wisdom. If you survive the gauntlet, if you keep your job, pay the VIG, avoid the collateral trap, and finally crawl across the finish line of that 30-year marathon, you've won, right? You now own an asset. That's what every financial guru, every real estate agent, and every well-meaning relative has told you your entire life. But this is where we have to slow down. Because this belief, more than any other, is the most sophisticated lie in the entire system. This is the asset myth. Now let's remove emotion. No nostalgia, no pride, just numbers. Here's the story you're told. You buy a house for $400,000. 30 years later, it's worth $800,000. On paper, you made $400,000. Sounds brilliant. But that's grocery store math. And grocery store math ruins lives, because it ignores everything that actually matters. Let's run the real ledger. First, interest. On a standard 30-year mortgage, you likely paid close to double the purchase price. That $400,000 house didn't cost you $400,000. It cost you $700,000, maybe $800,000. Then come property taxes. Quiet, relentless, non-negotiable. Over 3 decades, that's another $100,000 to $200,000. Gone forever. No return, no equity. Then maintenance, roofs, plumbing, heating, painting, landscaping. Emergencies at the worst possible time. A conservative rule is 1 to 2% of the home's value every year just to keep it from falling apart. Over 30 years, that's another massive 6-figure number. Now pause. Let that sink in. Silence. When you add it all together, interest, taxes, insurance, maintenance, and then adjust the final sale price for 3 decades of inflation, the profit often disappears completely. For millions of families, the home is not an investment. It's a forced savings account with a negative real return. You didn't grow wealth. You stored it in an extremely expensive box that slowly leaked. Repeat this with me. An asset pays you. A house charges you. And here's the deeper wound, the one almost no one calculates. Opportunity cost. This is the truth the system hopes you never run. Think about the down payment you scraped together. Think about the extra hundreds, sometimes thousands, You paid every month compared to modest rent. Now imagine that capital wasn't buried in drywall and concrete. Imagine it was invested. Compounding. Working while you slept. Money locked in your primary residence is dead equity. It doesn't compound. It doesn't generate cash flow. It consumes it. Real assets pay you. A house demands tribute. By convincing the middle class to sink most of their net worth into their residence, the system neutralizes their capital. It removes their ability to pivot, to invest, to take risk. You feel rich, but you're house rich and cash poor. Repeat this. Illiquid wealth is controlled wealth. So why is this narrative pushed so aggressively? Why do politicians, banks, and media treat homeownership like a moral duty? Because this isn't just finance, it's control economics. A population tied to a 30-year contract is predictable. If you have a massive mortgage, you're risk-averse. You don't strike. You don't quit. You don't challenge authority. Debt becomes a disciplinary tool. The mortgage ensures your labor is pre-sold, before you even wake up. The American dream wasn't just sold, it was engineered. And this is the moment where perspective changes everything. A home is not your greatest asset. It is a consumption choice. There is nothing wrong with wanting a nice place to live. The mistake is confusing lifestyle with investment. The wealthy understand this. They park capital in assets that generate cash flow, businesses, equities, systems, and they use that cash flow to pay for lifestyle. The middle class does the reverse. Waking up to this truth feels uncomfortable, like realizing the milestones you celebrated were actually shackles. But clarity is power. Once you stop asking, how much house can I afford? And start asking, what is the opportunity cost of this capital? Everything changes. This is the beginning of financial sovereignty. But awareness alone isn't enough. Diagnosis without action is just pain with better vocabulary. Now that we understand the trap, we need to talk about how to move inside it without being crushed, how to operate inside a rigged casino, and still walk away with your freedom. If this breakdown of the asset myth challenged how you view your home or your future, go to the comments and write just one sentence. My eyes are open, because now that we've named the disease, it's time to talk about the cure. We cannot end this journey in despair. That would be the final victory of the system. Because hopelessness is not a side effect of the machine. It is one of its core products. A hopeless person doesn't rebel. A hopeless person doesn't plan. A hopeless person signs the papers and keeps paying. And that is why the most radical act in this entire conversation is not anger, but clarity. Escaping the matrix is not about rejecting society or living on the margins. It is about understanding the rules so deeply that you stop being moved by them. The goal is simple, but profound: to move from financial servitude to financial sovereignty. Say it quietly to yourself, because this matters. Sovereignty changes everything. Let's break the solution into something tangible, not theories, not motivation posters, but 3 concrete pillars that shift you from chaos to control. Pillar 1, margin. Margin is where freedom lives. The greatest lie ever sold to the middle class is the word qualify. When a bank tells you that you qualify for a $500,000 mortgage, they are not offering guidance. They are calculating your maximum pain threshold. They are measuring how much pressure you can endure before collapse. Sovereign thinking rejects this completely. You do not buy what you qualify for. You buy far below it. When your housing costs are modest relative to your income, something extraordinary happens. Fear disappears. You gain space. You gain options. A missed paycheck becomes an inconvenience, not a catastrophe. Margin is not conservative. It is strategic. Margin is power. Pause here for a second. Just sit with that idea. Margin is not about what you can buy. Margin is about what can't break you. Pillar 2. Debt as a weapon, used carefully. Debt itself is not evil. Ignorance is. In untrained hands, debt is a blade turned inward. In trained hands, it becomes leverage. The system teaches you to stretch debt for 30 years, to normalize lifelong risk, to accept constant exposure as normal adulthood. Sovereignty rejects this timeline. By aggressively attacking principal early, Bi-weekly payments, extra contributions, front-loaded discipline, you shatter the amortization curve. You steal time back from the bank. Every dollar of principal you kill today is a dollar that cannot generate interest against you for decades. This is not speculation. This is math. It is one of the few guaranteed, risk-free returns available to an individual. You are not losing liquidity. You are buying back your future labor. Repeat this because it matters. Owning your time is the real return. Pillar 3. Turning shelter into strategy. The system wants your home to be pure consumption, a box that absorbs cash and produces nothing. But sovereignty reframes shelter as infrastructure. This is where concepts like house hacking matter. A duplex, a rented room, an accessory unit. Even small cash flow changes the entire equation. When income offsets expenses, the relationship flips. The house stops feeding on you and starts feeding you. This is not about becoming a landlord mogul. It is about neutralizing the drain, about refusing to let your largest expense remain passive. When your shelter contributes instead of consumes, you are no longer being farmed by the system. You are using its own tools against it. And this is where the definition of wealth collapses and rebuilds itself. Wealth is not visible. The big house, the luxury car, the perfect lawn. Those are often just monuments to efficient debt. True wealth is invisible. It is silence. It is low expenses. It is the ability to walk away. It is waking up without the low-grade panic that comes from knowing your life depends on a single paycheck clearing on time. True wealth is optionality. It is margin. It is sovereignty. The system does not bet on this version of you. It bets you will refinance, that you will upgrade, that you will trade freedom for appearances every 7 years. It bets you will stay predictable. The only way to win is to become unforecastable, to value freedom over status, to drive the older car, to live smaller than your peers, to pay off in 7 years what they normalize for 30. This path is not easy. It demands discipline in a culture addicted to convenience. It demands saying no while others say yes, but the reward is absolute. When you remove leverage from those who profit from your fear, you become something rare and dangerous to the system. A person who cannot be pressured, rushed, or financially bullied, a sovereign individual. If this resonates, not emotionally but logically, make a declaration. Not for me, for yourself. Go to the comments and write one sentence. I am changing the rules. Because once you decide to stop playing their game, the next step is learning how to win your own. And that is exactly where we're going next. If you're still here, it's because something clicked. Most people would have left already. You didn't. That tells me you're not here for noise. You're here for clarity. And this channel exists for people who refuse to stay asleep inside a rigged system. If you haven't subscribed yet, do it now, not later. This isn't just content. It's a continuing conversation about control, leverage, and freedom. I want to know who's serious. Go to the comments and write just one sentence. I am taking back control. That's not for me. That's a line you draw for yourself. And if this video shifted the way you see money, power, or debt, hit the like button. It's a small action, but it pushes this message to people who need it and haven't heard it yet. Now don't stop here. There's one more piece you need to see. On the screen right now is the video that explains how this system was built in the first place, the moment the rules were written against you. Click it. This is where it all connects.